He had a variable universal life policy. He'd put $800 a month into it for 20 years.
20 years.
But he had those years where the policy went down, cost of insurance was going up, so they had to take money out of sell shares to cover the cost. So not only was the policy cash account going down, they were now taking from the cash to support the cost of the insurance going up.
So it's going down, cost of insurance, and they're pulling out. So that's the triple down.
Exactly. So it just ate itself alive.
Right.
So 20 years later, he gets a notice saying, hey, this is going to lapse.
Which means it's
all
gone.
Your cash is gone.
No more death benefit either, which would have been tax-free. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. You've asked, we're answering here at the Money Matters with the YouTube channel. This is Garrett Gunderson, financial architect, you name it. But we have a question that came in from Dr. Q. Well, it was just a comment in YouTube, and I want to interact with everyone, and especially when there's questions like this. This is great video as always. Why, thank you. When you say pay yourself interest when loaning yourself money from your policy, this applies to whole life insurance overfunded policies, ? My insurance agent says only variable universal life policies allow you to pay interest when you pay back. Well, first off, you're borrowing against the cash you have in the policy. You aren't able to borrow more than that. You're borrowing against it. Doesn't matter what your credit score is. Doesn't matter, any of those factors. And then you're paying back the loan that they gave you. But if you die, they subtract it from the death benefit. There are no specific payback terms. And it's pretty much the same, whether it's variable universal life, or whole life, with maybe a few nuances. That's why I brought Tim Carden. I want to bring a financial nerd and expert that knows more than I do.
All right. Well, thank you very much. Appreciate that. You're right in that the loan coming out of the insurance policy in whole life is going to be collateralized by your cash value. So you're technically not paying the interest directly back into your policy. You're paying the interest on the loan. But I don't mind that because my policy never took a loss.
It's earning interest.
It's continuing to earn interest, which is always either very similar to or equal to the loan payment. So it's a zero cost loan. When I borrow from my policies, I call them up and say, send me my money. And they said, do you want it in your bank or do you want a check sent to you? That's the underwriting, basically.
Right.
So very liquid, very easy to get my hands on.
Now, variable universal life, when I was 18 years old, I bought a variable universal life policy, $70 a month. They showed me a rate of return of 18%, which is illegal. Over 40 years to show me off $70 a month, I'd become a multi-millionaire, right? Because I'm 19 years old at the time. They're like, cool, 40 years from now, you're still earlier than normal retirement age. And then I took an econometrics course in school, and I did these Monte Carlo simulations looking at different variables, and I thought, well, this is interesting that it's actually showing that it's not only not going to have money, that based upon the fees and everything else, there's a 97% chance it's not going to make it. So I want to talk about how variable universal life works, and I know you've pulled up an article from someone that writes in this capacity, but it's basically like having a term insurance policy that costs a little bit more than term insurance, and you fund extra into it. That's universal life in general. And variable means it's sub-accounts that act like mutual funds. And so you pick these mutual funds, and mutual funds go up and down in value based upon the share prices, right?
Exactly.
And so the way that universal life is assessed from a cost standpoint is the older you get, your mortality and expense can go up because of age, because you have a higher chance of death, right? And then second, they take the difference between the amount of death benefit you have, they subtract out your cash value, and that's called your net amount at risk. And they're assessing how much to charge you based upon the net amount at risk. So if you're getting older but your cash value is going up, you don't really notice that extra cost of insurance unless more people are dying that own a similar policy to you with the same company than anticipated. Then they can raise that cost of insurance from the current cost up to the guaranteed cost, and that takes time before they would get there, but it can start eating away at your policy. The bigger problem, if the stock market goes down, which it does at times, your cost of insurance goes up and they have to sell more shares to cover that increased cost. It's like a double negative, essentially, a double down.
Yeah, and these things cannibalize themselves all the time due to the exact situation you're talking about. I had only been in the industry maybe 5 years. I got a call from a client named Tom saying, hey, can you help me out with my dad's policy? I said, okay, send over what you've got. He has a letter. It's a lapse notice. He had a variable universal life policy. He'd put $800 a month into it for 20 years.
20 years.
But he had those years where the policy went down, cost of insurance was going up, so they had to take money out of sell shares to cover the cost. So not only was the policy cash account going down, they were now taking from the cash to support the cost of the insurance going up.
So it's going down, cost of insurance, and they're pulling out. So that's the triple down.
Exactly. So it just ate itself alive.
Right.
So 20 years later, he gets a notice saying, hey, this is going to lapse.
Which means it's
all
gone.
your cash is gone.
No more death benefit either, which would have been tax-free. And if you want to keep it, you have a much, much higher cost of insurance. So I called the VUL the very ugly life.
It's an appropriate name.
I admit that for 3 months I funded this at $70 a month, probably my least terrible mistake because it was only $210, and I've made other financial mistakes over time that I had to learn the hard way by losses versus listening. But that's how I started to learn when I was a very young age of 19, getting into this financial industry. And so if we look at the different types of insurance, you've got term insurance, which you might have level 10-year, level 20-year, level 30-year, or annually renewable term.
Yep.
So in the 11th year, the cost goes up substantially, or 21st, if it's a 20-year or 30-year, you pay a little bit more now to have it level for that period of time. And then annual renewable might be the lowest price today, but it starts increasing over time instead of remaining level. So term insurance is just like it sounds. You pay it, and you have it for that term. You stop paying, it's gone. And the research that we did when we were writing one of the books back in the day, I think it was actually What Would the Rockefellers Do? We found that 1.1% of term policies actually pay out.
Exactly. That's why it's the cheapest. There are no deals in the life insurance world or any insurance world. So they're going to price according to risk. And if their risk is really low, the price will be really low. Yeah. Right. And you think about permanent insurance. If whole life costs more, it's because it's more guaranteed, more permanent.
Right.
If variable universal life costs less initially, it's because they put all the risk on you. They took less risk.
So let's go to Universal Life. That really came from E.F. Hutton, which was a brokerage company back in the late 70s, and pretty genius, really, because what they did was say, hey, there's these really high interest rates, because you'd have to pay double-digit interest rates, like 12%, I don't know exactly the percentage, if you were trying to get a mortgage in the late 70s or early 80s, which also meant your savings accounts or your certificates of deposit were earning 12% and higher interest rates. So they thought we can actually take these insurance contracts that have tax benefits and have people stuff a whole bunch of money in there and get really high interest rates. And so it worked fantastically early on.
It did.
The government came in and said, we need to lower the amount people are putting in this because they're abusing the tax advantage, and they created these things called MEC limits, modified endowment contracts, that you can't put more than that or you lose some of that tax benefit.
Yeah.
Right? And then the 80s kind of started to level out, interest rates started to go down, and then we saw variable and universal life be born because the 90s was a phenomenal time in the stock market. I mean, that was the decade, right? Just double-digit interest rates of return, 30% some years. I mean, it was just crazy.
It was crazy. And it all goes back, if you look at the tax code, it makes perfect sense why that happened. In 1978 was the first year the 401k appeared in the tax code. However, when it was first used, it was utilized largely by executives, directors, vice presidents of companies as an add-on to their other benefits. So it wasn't until 1984 when Congress got involved to help us out, which that's always a bad idea when Congress gets involved to help us out, right? They come in and say, well, you have to have participation rules because you can't just offer it to executives. So they made it get offered to everybody. So we saw from like 1985 on this crazy run in the market. And it was because everybody's
making a deposit.
Everyone was buying.
They're just buying.
Yeah.
Right? Simple supply and demand.
Exactly.
So there's a lot of influx of money that's coming in, pushing those prices up. The 90s look great. So people with variable universal life, they were seeing huge returns until the year 2000, 2001, and 2002. Massive decrease. And we saw some of them implode over that short of a period of time.
That's
right.
I got the call from Tom. It was like in 2004.
Yeah. And then we look at 2008, 2009, 2010. That really crushed those plans to the point where I rarely hear about or see them anymore.
Well, and that's the thing. So I found this article by a gentleman named Peter Klatt. This is from the August issue of the Journal of Financial Planning. This is what he has to say about variable universal life. He says, however, variable universal lives are toxic insurance assets because of the extreme investment volatility that destroys policy owner confidence when the inevitable investment crashes occur.
Right. So investment crashes happen. The cost of insurance increases. It siphons even more money from this. You lose your guarantees. And then plus you're dealing with it from a psyche standpoint and being like, oh, this really sucks. But everybody remembered the 90s. So that's why we see this new policy enter in 2000, or I don't know when it came out. I believe it was the Indianapolis Life that issued it originally. It's the indexed universal life. So it's like, interest rates are kind of low, and so that's not getting you a lot. The stock market's kind of volatile, so let's give you a minimum guarantee of 0, 1, 2, or 3%, and let's let you participate in the upside and cap it off. So if the market did 30%, you're not getting 30%, but if it does negative 20%, you're not losing money. So it became increasingly popular, but still having some of the inherent issues. I mean, I'll admit I have one. I have one Indexed Universal Life, but I don't plan on utilizing the cash. I have a death benefit with it. I've got guaranteed riders, which I think the majority of people might have a hard time with, because if you miss a payment, which if we look over a lifetime, that could be just hundreds of premium payments, that could negate the guarantees. If you take out the cash, that might negate the guarantees. So it's like you said, there's no deals in the insurance business. I actually have an article coming out in Forbes where I interview the founder of Truth Concept Software, Todd Langford, who's brilliant at assessing these things and point out the top 10 risks. So I know that's not the most popular opinion, that Indexed Universal Life has major pitfalls and issues. But the reality is there's these three pieces of Universal Life that there's maybe even a few more hybrids. There's Universal, Variable Universal, and Index Universal. Yep. One is interest rate focused, one is stock market focused, and one is a hybrid of, like, they do a bunch of things like options trading and stuff to kind of create that thing. And you're not really dealing with that. You just get whatever's in the contract. But I think a lot of people are going to be surprised that if more people die than expected because they jump ship to a better policy when new provisions come out, which has happened over and over again, they might get closer to the guaranteed cost of insurance. And if you go through the column that says guaranteed cost, the policies don't survive.
They never do.
So I'm not looking at insurance as like my big wealth strategy that I'm going to get all my returns from. I look at it as my midterm strategy that I have guarantees, I have liquidity, I'm doing better than my savings accounts, and then I can capitalize. So the last type is whole life. And this is how I feel about most whole life policies out there. It's a hole that you throw your money into. They're designed atrociously bad. There's some that are so high commission with companies that aren't really prepared to issue these. So to get guarantees, you're years and years and years before you even have cash, and you might be decade or decades before you're at break even.
Yep.
So they deserve the bad name that they get from that standpoint, but there's still 24 companies out there that you could fund it where you get a lot less commission to the agent, a lot more cash to you, that puts you much, much further ahead. And so we have a lot of videos on that with cashflowbanking.com. We have videos here on the YouTube channel on this. But this particular question was just insane to me, that an agent would say it only works with Variable Universal Life to borrow and then pay yourself back interest. One, I've said the words pay yourself back interest. It's not exactly how it works. You've borrowed against your cash with the insurance company's money. You're paying them back, and you're keeping your money earning interest. So it's a collateralized loan, almost like you see with brokerage accounts sometimes, or even certificates of deposit at a bank.
Exactly. And what I love about the whole life product is that you're going to get those guarantees. When you look at the guaranteed column in your whole life product, the guarantee always grows. It grows and grows and grows. When you look at the guarantee column in an Index Universal Life, it goes away. It diminishes.
Yep.
And so I have a guaranteed product that's going to always grow. Nowhere else can I get that.
And if you really have good opportunities to invest, use the cash to invest.
Yep.
Don't use that as your main, workhorse for your entire finances. Use it as a place to capture money, store money, save money, get tax advantages, protect from liability, gather some benefits, reduce your cost of term insurance, all those factors, and then use that cash when the opportunities come. So I built a TV studio back in the day with that. I bought a company. I invested in down payments of real estate. I bought the very place where we're here with my cash values, and then just paid it back over time. So I wasn't using a bank, and I didn't have to go through all those, factors of financing, which when I refinanced my house a few years ago, it's like, maybe it's just time to pay it off. Now, and that's what some people like to do. But for me, I can do a little bit better with my cash than what I'm being charged. So I keep access to it, and I know I could pay it off at any time. So the purpose of this video was to really warn people of the issues when it comes to insurance. Yep. The thing that will do the least harm in the short term is term insurance, if you just don't know what to do.
Yep.
And it's really about, if something happened to you tomorrow, would you want your family to live the same lifestyle, a worse lifestyle, or maybe a better lifestyle? Mine's a caveat. A better lifestyle, but I want a pop-up book that when you open it, it throws the middle finger. And it's like, anyone that thinks that they just got rich marrying into this family, it's only for my wife and my kids, not for you. And I have a trust that gives them provisions. But I want them to live a continued improved quality of life, just like when I'm around. I look at this as a legacy thing, but everyone gets to make their choice. So get the right amount of insurance first. Make sure if you do get term, it's convertible. to another type of policy. Make sure that that's a company that's a mutual company instead of a stock company, so that you're not splitting stockholder dividends with policyholder dividends. You want multi-billion dollar companies. You want to make sure they have only A-type ratings with all the different agencies. These are some of the basic factors around for more than 100 years, always paying more than the minimum guarantee. And look at this as a place to store safely rather than risk with a lot of variables and moving pieces like we see with the other policies.
Yeah, and I would say I love the whole life insurance product because I say it's the best saving strategy that exists. And in saving strategy, I want something that's going to give me a guaranteed good return. Like, it doesn't have to be amazing, but a good solid return. It's going to have some tax advantage to it, but it's going to be liquid and no risk. I don't want risk in my saving strategy. Right. And so that whole life checks off all those boxes. It beats my savings accounts by several points. It is very safe, and it's very liquid. And so it's a perfect place to store cash while I determine where to invest and what to invest in. And then when I find the right investment, the cash is available immediately to me.
All right, you heard it. We've given you the warning. Don't fall for the hype. Don't chase the return and find out that you're going to lose your money like after 20 years like Tim's, friends did. So make sure that you know what you're doing and make sure that we get the facts right here for you, because, I'm glad that Dr. Q asked the question so we can kind of disseminate truth from falsehood, get you more informed, empower you so you can turn your thoughts into profits and build a life you love. This is Garrett Gunderson, and know that you're loved.